Hello and welcome to the second CBGA FTC Dialogues on Global Financial Transparency. We have with us today Dr. Jayati Ghosh, who will be speaking to us on the global minimum corporate tax and on the way ahead. Dr. Jayati Ghosh taught economics at Jawaharlal Nehru University in New Delhi for nearly 35 years. In January 2021, she joined the University of Massachusetts Amherst. She has authored and/or edited 20 books and has received several prizes, including for distinguished contributions to the social sciences in India in 2015, the International Labour Organization's Decent Work Research Prize for 2010, the NORDSIP Prize for Social Sciences 2010 Italy. She has advised governments in India and other countries, including as chairperson of the Andhra Pradesh Commission on Farmers' Welfare in 2004 and member of the National Knowledge Commission of India 2005 to 2009. She is the Executive Secretary of International Development Economics Associates and International Network of Heterodox Development Economists. She has consulted for international organizations including ILO, UNDP, UNCTAD, UN-DESA, UNRISD and UN Women, and is a member of several international commissions, including the International Commission for the Reform of International Corporate Taxation, ICRICT, the Commission for Global Economic Transformation of INET, and the WHO Council on the Economics of Health for All. Dr. Ghosh, welcome. And let me begin by asking you, so what is the global minimum corporate tax deal and how was the deal negotiated?
So this is something that actually developing countries and many tax analysts across the world have been asking for some time. What happens really is that because of the fact that multinational corporations can pretend that they're operating in many different places and can shift around their profits to different jurisdictions depending on where the tax rate is lower, they end up paying much less tax than the domestic companies. So for example, Apple India will be different from Apple France, will be different from Apple US, will be different from Apple Ireland. And then Apple India can say, well, you know, our sales in India are this much, but sorry, there's hardly any profit here. Because all of this is really, we have to pay to our subsidiary in Ireland, since they are the ones who hold all the intellectual property. And so then the profits are shifted to Ireland, where there's a lower tax rate. And then they have a deal, a double taxation treaty with the Netherlands. It's called the double Dutch-Irish sandwich. And they end up paying almost no tax in anywhere. This is what we have been trying to avoid for a very long time. So the independent commission of which I'm a part, which you've mentioned, has been saying for now at least 6 years that we should actually treat this company as one company. All multinational companies shouldn't be treated as separate companies in every country that they're in, but should be treated as one global company. And then every country will tax their share of the global profits according to its own tax rate. So if you do that, then there's no incentive to actually move the profits around, because anyway, you're going to be taxed a certain amount. And we have suggested a formula which is based on sales, employment, and assets in that country. That's one part of it. The other part is to make sure that this happens and there's still no incentive to move your profits. You should ideally have a minimum tax rate that every country charges. We have suggested a minimum tax rate of 25%, which is the median rate of all corporate taxes in the world. That's the middle of all the corporate tax rates in the world. So that seemed to us to be a very reasonable number. This idea has been resisted for a very long time, as you can imagine, but the OECD set up a process about, again, 6 to 7 years ago. It's called the Base Erosion and Profit Shifting Initiative. So the BEPS inclusive process, as they called it, because it began as an initiative of just the OECD countries, then they have added more countries. I think now there are about 132 countries who are involved in it. But let's face it, the decisions are made by the big players in the OECD. So this process has recently finally come up with a proposal for accepting both of these. What I have just described to you, Pillar 1 and Pillar 2, both of these have been accepted in principle. That's a huge victory for us. So definitely it's important that the idea has been accepted, that a multinational corporation should be treated as one, and that there should be a global minimum tax. But the problem is that because of corporate lobbying power, because the rich country governments have been totally persuaded by the multinationals based in their own countries, we've watered down the provisions to such an extent that the final result is going to mean very little additional revenue, especially for developing countries. So the first part, that you have to treat all corporations as one global corporation, and then every country taxes its share of the global profits, that has been watered down to, first of all, referring only to excess profits, which is a very peculiar concept. What does excess profit mean? Excess above 10%. No country taxes their corporation saying we will only tax your profits above 10%, first of all. So that's bizarre. And then only a small share of that will be susceptible to global sharing. 20%. So it's watered down to the point where it's meaningless. That's the first problem. The minimum tax, which is the one everyone's talking about, because finally we have one. The United States and Janet Yellen, the Treasury Secretary, originally suggested 21%, which is not as good as 25, but okay, 21% still acceptable. By the time it got to the G7, it was further watered down, and now it is at 15%. Which is really low, which is actually the same, almost as much as the tax havens of Ireland and the Netherlands. They are charging 12.5%. So it's a very, very low minimum tax rate. And that's a real problem for countries like India, because we, as you know, have a higher tax rate, 24, 25%. And so in a sense, we're still susceptible to companies shifting their profits away to the lower tax jurisdictions because the minimum rate is far too low.
So what has been India's stand earlier, and was there any shift, of late? And are there any steps that we as a country should take in the direction of enhancing the tax revenues?
India earlier had taken a very good and progressive position on this, and they had submitted, in fact, a number of very important proposals along the lines that I've mentioned. India is part of the G24 group in the Bretton Woods institutions, which has been making similar proposals to the OECD process. Unfortunately, in the latest G20 meeting, and then finally in the OECD BEPS initiative meeting, India succumbed and went along with the available proposals. There are two problems here. One is that one of the ways in which India could exercise leverage is that we had brought in a digital tax of 5% just on turnover of digital companies, because at the moment they pay no tax at all. And so this would be one way of actually getting something. And the United States has been opposing this. So it has got after all the countries that have done this digital tax. And it's threatened them with trade sanctions. I mean, it's been really quite appalling in the way it's dealt with this. And just today, there is a news item that India has come to a compromise with the US on this digital taxation. So we no longer have that bargaining power. We can no longer say we're not going to accept something and we're not going to remove our digital tax until you give us a fair deal. We don't know what the terms of that compromise are. They haven't been revealed, but I suspect that it's not good news. So India has changed its position. Why has India changed its position? Partly, I imagine, pressure from the G7 countries, particularly the US, partly because we're very anxious to appear investor-friendly globally and attract more foreign investment. Not that the foreign investment always goes according to the lower tax rates, but as a result of this, there's a real fear that we will end up getting less taxation from multinationals than we got in the past, because we've given up something without really getting much in return.
And so what does this deal mean for other countries of the Global South? And, what can countries of the Global South do to ensure that they're represented and heard at global platforms when such decisions are made?
You're absolutely right that this need to be heard in global platforms is the most important. So developing countries have been saying for a while that it shouldn't be the OECD that is deciding this. The UN, the United Nations, has a tax committee. And that is, at the moment, it's not an empowered committee, as they say, but it is nonetheless an advisory committee. Developing countries, the group of 77, they have been asking for several years now that the UN tax committee should be taking this up. They have got very good proposals. They should be empowered to actually suggest things that all countries have to implement. Unfortunately, we know that the way things happen globally is not because of the existence of a formal structure, but because of power imbalances. And really, G7 has not listened. Okay, they haven't bothered. So at the moment, the current tax deal, developing countries are going to get next to nothing, because the pillar one that I talked about, the fact that you will treat all multinationals as one company, rather than little bits and pieces in different countries with arm's length with each other, that part has been watered down, watered down, watered down. Only companies above a certain size, only more than 10% of their profits, only a share of that excess profit. So we are going to get almost nothing in terms of any money from that, any revenues from that. The minimum tax rate is worse because our tax rates on the whole are much higher. In fact, the average developing country tax rate for corporations is more than 30%. We just brought ours down to 24, if you remember. So we are, most developing countries might end up losing revenues rather than gaining from this deal. It's a real concern. In this context, what should they do? I think one of the problems has been in the negotiations so far that we come to the negotiations as, if you like, requesters. We plead with the developed countries, please help us, please do listen to what we're saying and all of that. That way, it's important for us to have some bargaining chips. If a lot of developing countries get together and say, well, okay, we are going to do this. We are going to tax the following all the multinationals according to our share of their global profits. It will be very hard for those multinationals to say, we will not operate in India, Brazil, South Africa, China, Turkey. They're not going to say that. If we could come together ourselves. Now, what's so interesting is that the rulers of the world, G7, they are a cartel. They function as a group. They can impose their will. The rest of us, we allow that to happen because we don't function as a group. So it is really important for us to get together. And, India could play, in the past, it had played a positive role in this respect. It doesn't do that at the moment. That's very unfortunate. But there is a real scope for developing countries to get together. The African Union has been saying this, that, let's get together and do this. Because, individually we cannot win. The multinational will always have more power and say, well, we're just leaving your country. But when you think of the big digital companies, is Facebook going to leave India? It's the largest source of revenue. Is any of these big corporations going to leave India? No. But we are so terrified that we then allow all this to happen. If we got together, if even the developing countries in G20 got together and said that we are actually going to do this together, it would make a huge difference.
What is the future of this deal? What are the next steps and what will be the long-term implications for different countries?
This deal benefits the G7. Basically, it benefits rich countries. It will give them some additional tax revenues. At the moment, it's not even clear whether we will get additional tax revenues, as I told you, because we could end up even losing out, depending on what the companies do in response. I think the good thing about this tax deal is that the principle has been recognized, as I told you. And that's very important because all these years, this principle was not accepted. And you can imagine multinational lobbies fought like anything to prevent that principle from being recognized. But recognizing the principle is a very important first step. So it's, if you like, it's the thin end of the wedge. At least we've got that. Now that we have that, we have to keep the pressure up to demand a more equitable and just version of the deal. Right now, it's not a deal. Right now, anyone who says that this is a new revolutionary deal that is going to deliver much more tax revenues is lying. So we have to demand that, okay, you've accepted the principle, but it's not working because you have put in all these conditions. We have to make this something which actually benefits all the governments and people of the world. And the way to do it is quite straightforward. In ICRICT, in the Independent Commission for the Reform of International Corporate Taxation, we have suggested various different measures and ways in which this can be implemented. We've done calculations for what happens when you have a 25% minimum corporate tax rate, 21%, 15%, and oh my God, the numbers collapse, especially for developing countries. So we can actually implement, if we want, a much bigger and more just and equitable and desirable form of global corporate taxation. Remember, it's not anything punitive for multinationals. It's just asking them to pay the same rate domestic companies pay. That's all. There's nothing, like terrible and aggressive. It's just saying, look, our domestic companies are paying this tax. You should be paying this tax. That's all. It's not going to be easy. It's an uphill struggle. But as I said, the principle has been accepted. So that's the direction in which we need to move.
On a different note, given your prolific academic career and your intellectual life, what is your advice to young researchers, activists, and policy professionals who are starting out in the field of financial transparency or tax justice and other thematic areas?
Wow, that's a very big question and an important question. I would say that this is, as people are very fond of saying nowadays, it's the best of times, it's the worst of times. In many ways, obviously, it's the worst of times. Yes, because you can see that there is so much uncertainty, there is so much pushback, there is so much aggression on the part of those who fear that their power is threatened and all of that, especially young people who are entering this and working for tax justice, they face a lot of obstacles. There's no doubt about that. On the other hand, it's also a very exciting time because suddenly it's opened up in a way. There's more awareness of this. I think the work of some NGOs, including yours, but a bunch of others, in exposing how much people are losing and citizens are losing because of this, and how it's unnecessary and of course unfair. I think that work has been important, so there's more public awareness. And I think it's now much more possible to actually begin to create shifts in policy stance. So my advice to all of you young people is, don't give up. This is one of the best times to be in this because you can actually force changes. Don't give up. Focus a lot on the detail because, they don't let anybody present to the public saying, oh, this is too technical, you won't understand it. Make it as simple as possible for ordinary people so they will understand it and see the politics of it. And keep your eye on the medium term. Don't expect a victory today, tomorrow, next month. Keep your eye on the medium term and then the victories will come.
Thank you so much, Dr. Ghosh, for your time and for your insights. And we look forward to having you back on this series again.
Thank you. Thank you and keep up the good work.